Most people believe that accounting is one of the most complex topics in the economic sciences. There are so uncountable notions, terms, labels, acronyms, which are subject to many different classifications. They are just like Lego bricks, and the relationships among these items, among these bricks, is cognitively demanding. Some people know that from the inextricable network of the accounting magnitudes, three financial statements pop up magically, called the balance sheet, the income statement, and the cash flow statement. They seem to be unrelated one another, as they are often presented isolated in accounting courses. Each financial statement is actually rather difficult to understand, and the relationships among the three statements do not seem to be so intuitive at all. What do they mean? What are the relationships of these statements at a given date, and what are the relationships at two different dates? These statements, and in general the accounting system, is perceived by most people as a labyrinth, as an intricate network, and a Byzantine system of describing a firm's operations and its business and financing transactions. In this video, I propose a simple method to get rid of the nebula which clouds the simple meaning of the accounting magnitudes and their intuitive relations. I will only use three ingredients, two simple laws, and one intuitive tool, a matrix, to explain the accounting magnitudes, their relationships, and how the financial statements arise. The three ingredients are capital, income, and cash flow. Capital is a monetary amount committed in the economic activity at a given date. Income is the growth of the capital within a given period. Cash flow is a monetary amount extracted from or injected in the economic unit. Two laws, the law of conservation and the law of motion, reflect the fact that every economic unit is a mechanical body endowed with the dynamics and statics. In particular, the law of motion says that the capital is subject to forces that modify its level across time, while the law of conservation says that every instant t, each one of the fundamental ingredients, capital, income, and cash flow, is subject to equal and opposite forces that balance out and determine a static equilibrium. Finally, I will combine the static and dynamical dimensions of the economic unit into one matrix, which I will call the split-screen matrix. So, let's remember these numbers again. 3, 2, 1. Let's go. As a first thing, consider that the capital of any economic unit, and in particular a firm, evolves over time just like a savings and credit account. Suppose a firm is incorporated at time 0 with an injection of 100 from capital providers. The firm invests those $100, and suppose that in the first year the firm's income, the firm's profit, is equal to 10. This means that the level of the capital increases to 110. At time 1, the firm pays, say, $20 cash to capital providers, which means that $20 are extracted, withdrawn from the firm. The firm's capital then decreases to 90, which is the capital invested by the firm at the beginning of the second period, that is, at time 1. In this second period, the firm's investments generate $9 income, so the end of period capital rises to 99. Suppose again that the firm distributes $30 to capital providers, so the next beginning of period capital is 69. This is the capital invested by the firm at the beginning of the third period. Let's assume that the third period income is 6.9 and that at the end of the third period the firm liquidates, which means that the entire firm's capital is distributed to the capital providers. So the firm's capital at the beginning of the fourth period, time 3, is 0 because the operations are over. Now note that in every period the capital amount varies and the sources of variation are the income and the cash flow. The cash flow which goes out of the firm and is distributed to the capital providers. This motion is just like the motion of a savings and credit account where the investor deposits funds in the account. The account balance increases of the interest, which is the remuneration of the capital, and then decreases by withdrawals or increases by additional injections. So the firm may well be interpreted as an account whose balance is the firm's capital. And the remuneration of the capital is the income or profit or earnings. And the deposits or withdrawals of the investor are just the distributions of cash flow to capital providers or contributions of cash flows by capital providers. Using symbols, if C denotes the capital, I denotes the income, F denotes the cash flow, then the capital at time t is obtained from the preceding capital as of time t minus 1, plus the income as of time t minus the cash flow as of time t. And this is the law of motion, which iterates in every period up to the end of the operations. It is also useful to think of the firm's capital as a reservoir of liquid, a tank, a cistern. The level of the cistern at a given date is the capital amount at a given date. Using the first period of the example I have just illustrated, we see that at time t minus 1, the level of the cistern is $100. It increases after one period, at time t, so the end of period cistern's level is 110. 10 is the income. Then 20 is withdrawn from the cistern, so that the new level at time t, the beginning of the period of period t plus 1, is 90. Now, as you see, the change in the level of the cistern is minus 10. The level is smaller at time t, and it can be viewed as the difference between the new level, 90, and the old level, 100. Or it can be equivalently viewed as the difference between the income, 10, and the cash flow, 20. In general, using the delta symbol, which is the symbol which denotes changes, variation, we can write that the difference between two consecutive capital levels is equal to I minus F. I minus F, income minus cash flow. This law of motion holds for any economic unit. It holds for savings account, it holds for firms, it holds for securities, it holds for loan contracts, it even holds for the public debt. The demands are different. The terminology used is different, but the logic is the same. For example, let's take the comparison between a loan and a firm. In a loan contract, the capital is called principal, whereas in the firm, the capital is called assets, or invested capital, or capital employed. But the meaning is the same. It is the amount of resources committed by an investor. It is the amount of resources committed by an investor, the creditor in the loan contract, the capital providers, the claim holders in the firm. In a loan contract, the remuneration of the capital is called interest, whereas in a firm, it is called profit or earnings or just income. But the meaning is the same. It's the growth of the capital within a period. In a loan contract, the cash flow is called installment. In a firm, it is called cash flow from assets. And the same occurs for any economic unit. Now, I rewrite the law of motion as a matrix of 1 row and 4 columns. The red vertical bar denotes equality. The time t capital is equal to the time t minus 1 capital to the time t minus 1 capital plus the income minus the cash flow. Let's now consider the statics of an economic unit, and in particular the statics of a firm. Let's take back the first period of the example I have presented some minutes ago. The firm invests 100 at time 0. The $10 income increases the capital, which is decreased by $20 because $20 are pulled out from the firm, and the resulting new capital amounts to $90. Okay, we say that the firm invests $100 at the beginning of period T. But how can it invest $100? It must raise funds from someone who provides those funds. So the firm invests $100 only because someone deposits $100 in the firm. So there are 100 investments, but there are also 100 financings. The firm is at the same time in an investment position and in a financing position. It is in a static equilibrium at every date. This is the static equilibrium of the capital. Investments equate financings. Such a law holds for income as well. The investments generate $10 income, but then income is accrued to whom? To the capital providers. That income is not owned by the firm. It is owed by the firm to the capital providers. So income from investments is equal to income to capital providers at every date. This is the law of conservation for income. Finally, those $90 invested, they go out of the firm, thereby reducing the level of the firm's capital, the level of the cistern. But where do those $20 go? Well, they are distributed to capital providers, to the claim holders. Capital providers precisely receive the amount which is subtracted from the firm. Therefore, the cash flow from investments is equal to the cash flow distributed to the capital providers. And this is the law of conservation for cash flows. Finally, the capital invested at the beginning of the new period is exactly equal to the capital raised, the capital financed by capital providers at the beginning of the new period. Using the superscript INV for investment and FIN for financing, we can write the static equilibrium for the three fundamental ingredients. The capital invested is equal to the capital which is financed by the capital providers. The income from investments is equal to the income to financings, that is the income to capital providers. And the cash flow from investments is equal to the cash flow distributed to capital providers. And note that the law of motion holds for both systems, the system of investments and the system of financings. We can now combine the two laws of motion and of conservation into one matrix with 2 rows and 4 columns. The red bars indicate equality, equality by rows and equality by columns. Reading the matrix horizontally, we have the laws of motion for investments and financings. Reading it vertically, we have the laws of conservation for the capital amounts at 2 consecutive dates, the first 2 columns. The law of conservation for the incomes and the law of conservation for the cash flows. This matrix is then partitioned into 4 screens, 4 quadrants, and I will call it the split screen matrix. The elements of all 4 screens coincide, which means that we have 4 ways to conceptualize and formalize the same concept, which is the firm's capital at a given date t. So we might say that we have a quadruple entry system. Now, the first column of the matrix is called balance sheet as of time t. And the second column is the balance sheet as of time t minus 1. The third column is the income statement. And the fourth column is the cash flow statement. The balance sheet represents the static equilibrium of capital amounts. The income statement represents the static equilibrium of incomes. The cash flow statement expresses the static equilibrium of cash flows. The split screen matrix integrates the 3 financial statements, and given that it chain links 2 consecutive balance sheets, we can say that the split screen matrix gives voice to a dynamical balance sheet. And we can say that the law of motion expresses the relations among the balance sheet, the income statement, and the cash flow statement. Specifically, the balance sheet at a given date t is equal to the balance sheet at the previous date plus the income statement minus the cash flow statement. In the accounting terminology, the balances of those capital are called book values or accounting values. Here I show a numerical example. The numbers refer to the first period of the example I have presented some minutes ago. The dynamical evolution is read horizontally, while the static relations are grasped vertically. 100 is the capital invested by the firm because it has raised $100 from capital providers. The invested capital generates $10 income, which is income accrued to the capital providers. Then the firm withdraws $20 and distributes them to the capital providers. The result is that the capital invested has decreased to 90. And symmetrically, the amount of money owed by the firm to the claim holders has reduced to 90, the firm is always in equilibrium with respect to the investment and with respect to the financings. Investments and financings are two economic systems, which include two subsystems, two classes. Investments can be operating investments or operating assets, or non-operating investments, typically liquid assets, financial assets. And the financing capital and financings can be divided into debt capital and equity capital. Each one of these four classes fulfill the law of motion. On the investment side, we have the operating capital or operating assets, which increase by an income component, which is called operating income or operating profit, and decreases by the cash flow subtracted from the operating capital, or increases if there is an additional contribution into the operating system, capital expenditure, for example, capital expenditures. The non-operating assets, the liquid assets, increase by the non-operating income, or also called the interest income, and decreases by withdrawals from the liquid assets. Cash flow from the liquid assets, or the balance of liquid assets, may increase if there are additional contributions into liquid assets. On the financing side, we have that debt increases by an income component, which is called interest expenses or financial expenses, and decreases by the cash flow to debt, paid by the firm to the debt holders. Finally, the equity increases by the income component, which is called net income or net earnings, and decreases by the distribution of cash flow to equity holders, typically the dividends or repurchases of shares by the firm. Here I take back the example and assume that $45 are raised from the equity holders at the beginning of the period and $55 are raised from debt holders. That makes $100 raised from the claim holders, from the capital providers. The firm invests $100 received from the fund providers, 75% into operating investments and 25% into liquid assets. Let's assume that the operating assets generate an operating profit of $7 and that the interest income is $3. This means that the investments overall generate $10 income. Of these $10, $4 are owed to the debt holders. This is interest expense. And the remaining $6 are the equity holders' income. Then the firm extracts $12 from the operating investments and $8 from the liquid assets, so that the balance of operating assets and liquid assets decrease to 70 and 20 respectively. These 20 collected from the operating assets and the liquid assets are distributed to the claim holders. $9 are paid out to debt holders and $11 are paid out to equity holders as dividends. Therefore, the debt reduces to 50 and the equity reduces to 40. The financial position of the firm toward the capital providers reduces to 90, which is just the capital invested at the beginning of the next period, and so on, and so on. Note, the split screen matrix gives us 4 different ways of conceptualizing, understanding, and formalizing a firm's capital at a given date. The upper left partition shows the static structure of the capital from an investment perspective, operating versus non-operating assets. The lower left partition shows the static structure of the capital from a financing perspective. The upper right partition combines the law of motion and the law of conservation from an investment perspective, showing the previous state balances on the two investment classes at time t-1, their income variations, and their cash flow variations. The lower right partition combines the law of motion and the law of conservation from a financing perspective, showing the previous state balances of the two financing classes, their income components and their cash flow components. I would like to stress that the firm is now an economic system which is broken down to 4 subsystems, each of which behaves from a logical point of view just like a savings account. For example, operating investments is just like an account whose balance is $75 at the beginning of the period. It increases within the period by $7, which is the remuneration of the capital invested in the account, and then decreases by the cash flow extracted from the operating system, just like a savings account. Now, we have started with a simple dynamical relation which is valid for any economic system. Then we have expanded the one-row matrix into a two-row matrix, which I call the split-screen matrix. And so doing, I have highlighted the two perspectives, investments and financings. Then we have expanded further the split-screen matrix into a four-row matrix showing 4 classes: operating assets, liquid assets, debt capital, and equity capital. Now, for those who are already acquainted with accounting, you can see now that indeed those columns represent the financial statements of a firm. But they are not isolated, leaving their relations unknown. This matrix structure unearths the relations among the financial statements, the dynamical relations and the static relations, so making it more intuitive. The split-screen matrix discloses such relations in a very significant way and in an intuitive way. But there is more than this. In actual fact, the split-screen matrix is a moving machine. What do I mean by that? Let's see. I mean that it is a shape-shifting logical machine equipped with what I call the split-screen technique, which enables one to carve out from the structure any kind of accounting and financial piece of information is desired. Let's see how it works with some examples. First, I remind that the red bars stand for equality signs, so the split-screen matrix may be seen as 2 systems of equalities, one read by rows and one read by columns. This fact has a striking implication. A row in the lower region may be shifted up in the upper region, or vice versa. A row in the upper region may be shifted down to the lower region, as long as we change the signs of its elements, just as we do when we deal with equalities or equations. So let's shift the third row, the debt row, up to the upper region by changing the signs of its elements. We get this. In this format, the split-screen matrix shows the equity capital. The upper left partition gives us the equity capital in a static perspective, using the law of conservation. It says that at a given date, equity is given by the sum of the operating assets and liquid assets, less the debt capital. The lower right partition gives us equity in a dynamical perspective, using the law of motion. Equity at time t is given by the preceding equity plus the net income less the cash flow distributed to equity holders. The upper right partition supplies equity by breaking down statically the law of motion. It breaks down the equity capital at time t minus 1, it breaks down the net income as of time t, and it breaks down the cash flow to equity as of time t. Note that the third column is the standard income statement as it is described in any accounting textbook, where the net income is obtained as a residual amount from operating income, and interest expenses. Another property of the split screen matrix is that a column in the right region may be shifted to the left region as long as the signs of its elements are changed, and vice versa, a column in the left region may be shifted to the right region as long as the signs of its elements are changed. So let's move the cash flow statement column, the last column, leftward by changing signs. What do we get? We get 4 different ways of cognizing the end of period equity before this distribution of cash flows to equity holders. The end of period equity capital can be viewed as the previous year capital plus the net income, or it can be viewed as the sum of the equity capital at time t plus the cash flow distributed to the equity holders, or it can be viewed as the sum of the previous year balances of the other classes of capitals, operating, liquid, and debt, and their respective income components. And analogously, we can conceptualize the end of period equity as composed of 3 types of cash flows, operating, non-operating, and debt cash flow, and 3 types of time t capital. Let's proceed and suppose we want to obtain the cash flow to equity. It suffices to move the second column rightward by changing signs. The result is this. This format describes the cash flow to equity. But I want that the second column and the fourth column are placed side by side. So I can simply place the second column next to the fourth column. No need of changing signs because the column remains inside the same partition. So I just place the second column next to the fourth column, and we get this. And this way we can see that the cash flow to equity is equal to the net income minus the change in equity. Actually, all the rows in this new structure say that the cash flow of the respective class is equal to the income minus the change in capital. This is just what we have seen earlier when we used the metaphor of the tank reservoir or the cistern. But here we also see in a static perspective that the cash flow to equity is given by the sum of the operating cash flow and the non-operating cash flow netted out of the cash flow to debt holders. So the cash flow to equity is viewed as a residual amount. The upper right partition disaggregates the lower right partition, so it supplies the cash flow to equity in terms of the 3 income components, operating, non-operating, and debt, and the 3 changes of capital amounts, changes in the book values of the 3 classes. Now let's move the equity row upward and the liquid asset row downward. What do we get? from this to this. The amount in the lower left partition is the cash retained in the firm, retained cash. More precisely, if it is positive, then it is cash retained, that is, cash flow which is generated by the operating assets, which is not distributed to the claim holders, and is invested in liquid assets, or simply deposited in bank accounts. Otherwise, if it's negative, it represents withdrawals from liquid assets. Now let's consolidate the last two columns just to highlight the change in book value. From this to this. We have just consolidated and indicated with the delta symbol the change in the capital amounts. Here is a more compact form. Let's focus on the upper left partition. Statically, the cash retained is what remains from the operating cash flow after servicing the debt holders and the equity holders. More precisely, the difference between the operating cash flow and the cash flow to debt is the so-called free cash flow to equity, or potential dividends. This is the cash flow that can be distributed to equity holders. This is the cash flow that is available to distribution to equity holders. We subtract the cash that is actually distributed to equity holders and find the retained cash. The upper right partition supplies a more detailed breakdown in terms of income components and book value components. We can draw any kind of accounting information with the split screen matrix. But suppose we want to obtain information on some rate of return. We want to measure the return on the invested capital. More precisely, on the operating part of the investment capital. How can we find it starting from this format? Let's move the debt row and the equity row downward to the lower region. We find the operating cash flow matrix. We see the operating cash flow from a static point of view, from a dynamical point of view, and via a static disaggregation of the dynamical perspective. Let's now shift the third column leftward, and we get the operating income matrix, where operating income is displayed in three different ways. Finally, we can divide each cell of the matrix, each element of this matrix, by the same number, namely the beginning of period operating assets, the beginning of period invested capital. And we get this matrix, the return on investment matrix, the ROI matrix. The ROI is one of the most important measures of accounting return. With the split screen matrix, we can see it under four lenses, four different but logically equivalent ways. It's the ratio of the operating income to the beginning of period operating assets. Also, dynamically speaking, it can be broken down to an operating dividend rate and the change in operating assets. Furthermore, we can see that the ROI is broken down into three areas: the debt, the equity, and the liquid assets. The first two rates tell us how much return is accrued to the claim holders, debt holders and equity holders respectively. And the third one tells us how much of that return is attributable to the financial assets. The algebraic sum of those three components is mathematically just a weighted mean of the return on debt the return on equity, and the return on non-operating assets, where the weight of the non-operating assets is negative because we must subtract the return on non-operating assets from the overall return. We must subtract the return on non-operating assets from the overall return to get the return of the operating investments. And the fourth conceptualization is in terms of the disaggregation of the dividend rate, that is the static disaggregation of the dividend rate and the static disaggregation of the change in operating assets. Let's now expand the detail of the analysis and expand the operating area. This area is an economic system which can be broken down into 6 different subsystems. Needless to say, each and every subsystem fulfills the law of motion, so that a change in the capital amount, a change in the book value, to use the accounting terminology, is caused by either the income component or the cash flow component, or both. Here are the 6 classes, each one with its respective capital component, income component, cash flow component. For example, accounts receivable represent the balance of money due to a firm by its customers for goods delivered but not paid yet. This balance increases by the sales revenues of the period, but decreases by the cash paid by the customers to the firm in that period. Same with accounts payable, but accounts payable represent a debt, an operating debt. It represents the company's obligations toward the suppliers. And this debt, this obligation, increases by the cost of the supplies purchased by the firm in the period, and at the same time it decreases by the amount of cash paid by the firm to the suppliers. Vertically, the first column expresses the balance of the operating assets, net of the operating liabilities, like the accounts payable, or the salaries and wages payable, or the taxes payable. The second column is a breakdown of the operating income. It consists of sales revenues, the change in inventory, which is the income component of the inventory, net of the cost of purchases, the cost of labor, the depreciation charges, and the income taxes. And the third column is a breakdown of the operating cash flow, which is represented by the inflows generated by the cash paid by the customers, less the cash paid to suppliers, the cash paid to employees, the capital expenditures, and the tax payments. We can expand the operating row of the split screen matrix into an enlarged split screen matrix with 9 rows, where I use some acronyms to refer to the various classes. AR is accounts receivable, AP is accounts payable, TP is taxes payable, and so on. The dimension increases, but the level of complexity does not, because all the classes fulfill the same law of motion, and the law of conservation keeps on holding. The first 6 rows pertain to the operating area and refer to the relationships of the firm with the customers, with the suppliers, with the employees, with the treasury. Then we have the inventory and the fixed assets, property, plant, and equipment. Each class brings about its own capital component, income component, and cash flow component. The law of motion holds for each and every class. So we started with a very simple relation. Then we have expanded it in a germ matrix with 2 rows. describing the investment perspective and the financing perspective. In other words, describing the law of conservation. Then, we have broken down investments and financings. And now we have further enlarged the split-screen matrix. The last matrix contains the previous matrix, which contains the previous one, and so on. We could call it a babushka doll system, a Russian doll system. It's far too obvious that we can build another, larger matrix which contains the current one, and the dimension of the matrix will be discretionary. Understanding does not become more complex. The degree of analytical complexity remains low because every new class added will always abide by the law of motion and will be incorporated by the law of conservation, which guarantees the equilibrium of book values, of incomes, and of cash flows. It should be clear now that, equipped with a split-screen matrix and the associated split-screen technique, we can manage any kind of accounting problem. I would like to cross-refer you to my book titled Investment Decisions and the Logic of Valuation, subtitle Linking Finance, Accounting and Engineering. In this book, this system and the split-screen matrix is introduced and developed in some detail. Indeed, as the subtitle suggests, with the split-screen matrix it's possible to understand finance as well as accounting, and merge finance and accounting to give rise to what I call accounting and finance engineering system. But this will be the subject of other videos. Thanks for your attention.